Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Let's take a quick look at Crocs. I've done a bunch of videos on these guys, so check those out if you want more details on what they do. Stock is down 3.5% today. Earnings were out. Stock initially dropped to about 125 bucks, up a little bit, down a little bit again. Are the earnings that bad? Not really. Do note that I own shares of Crocs. I was a buyer in the mid 80s. The thesis here was this is a company that's continuing to grow, even if it grows slowly. The free cash flow yield at that level was very attractive. Now it's a bit more expensive, but it's still growing. The free cash flow yield is still attractive, so it's worth a revisit to look at the earnings and where this company is headed and the troubles it has ahead. So revenue is growing at 5% per Q2. That's better than the guidance of 1 to 3% that they gave, and that's mainly due to Crocs brand revenues growing at 11% versus the 7 to 9% that they gave last quarter. Hey Dude still sucks, down 17.5%. This is a brand that they bought for $2.5 billion just a couple of years ago with the assumption that they're going to continue growing, and it's not doing very well for them, shrinking in the low teens for the year, in the high teens for the quarter. Not really solid. The questions remain about the acquisition. If they bought it today, they'd probably buy it a sliver of the price that they paid back then, and now they have all this debt that they have to pay down, and they could be using that money to actually buy back more shares. So that's a bit unfortunate for shareholders. At the end of the day, this is still a Crocs brand play. Hey Dude is there, but it's kind of a detriment at this point. The goal with Hey Dude would be to stabilize it, start growing it slowly again from whatever base they set up. And they're doing some of that, some things that they're doing. Again, they're investing in Crocs, they're investing in Hey Dude, but I think Crocs is the brand that you're looking at here. They do a good job of partnering with interesting brands, release interesting, unique shoes, limited time shoe releases, that sort of stuff. And these are shoes that aren't too expensive, which I think is very important in this climate. Again, Nike on their call, their mediocre call, talked about how they have to focus more on the under $100 customer. And Crocs is already there. Obviously, different types of shoes. These are sandals, these are clogs, that sort of thing, not sneakers. But you can get a Crocs shoe for $29.99. That's a lot more attractive to a consumer that's struggling with their wallet than some $200 footwear that Nike is releasing. And again, Crocs is doing a really good job with these limited edition releases, whether they're partnering with Pringles or Naruto, or even expanding into the standard sandal wear space and releasing these weird things that I've seen all over Instagram. You know, it's a Gundam clog, and it's like, well, this is weird and it looks kind of ugly, but people are still going to buy a bunch of it because there's a lot of collectors who like Gundam or like Naruto or like Pringles for whatever reason, and they like the type of fun element that a shoe like this offers, and that's what Crocs does really well. So they're growing well internationally, 22% growth, China growing at over 70%, and the Hey Dude kind of sucks. They're opening outlet locations. Their whole thing is going to be, you know, we want to maintain price integrity on these things. We're cutting back on our wholesale partners who are putting some of this stuff on sale. We want to make sure that this is a long-term brand for us with good price health. They're opening their own outlets, 13 open during Q2. They're entering international markets, doing what they did with Crocs. And again, Crocs, obviously very successful internationally, remains to be seen whether or not Hey Dude can recover and start growing again. The thing with this brand, though, margins are amazing. 64% margins on Crocs, 49% gross margins on Hey Dude. Adjusted operating margins in the 30% range, free cash flow margins in the 20% range. Inventory's down a bit again through that channel change on Hey Dude. And then 2024, they're investing in their brand, a little bit of pressure on margins there. They're paying down debt, total borrowings down to $1.5 billion. So they've already paid down over $1 billion of their debt that they took on with the acquisition of Hey Dude, and then returning capital to shareholders via share buybacks. So they're buying back shares in 2024, repaying debt, getting in a better financial position. The worry, the reason the stock is down a little bit is that Q3 guidance kind of sucked, basically flat to slightly negative in Q3. I think the market expected, you know, slow, low single digit growth again, pressure from Hey Dude, low growth from Crocs. One thing to note is that their Q1 guidance was 1 to 3%. They hit 5%, so I wouldn't be surprised if they do achieve low single-digit growth in Q3, and their 2024 guidance not impacted at all. And then remember, this is a company that generates 12.65 at the midpoint EPS against a price point in the 120s. So you're getting a 10x multiple on a company that's still growing for the year, that has really good margins, Why is that the case? Well, I think the market looked at this and said, this thing exploded in 21, 22, 23 as people kind of looked at unique shoe options, stayed at home more, liked the brand for its comfort. But before then, it was kind of a flat grower, and now it's kind of returning to being a flat grower. That's true, but I don't think this company that has to grow at a massive clip from this price point to be a good compounder. And as we look at the valuation disclaimer, this video is purely for informational purposes only. It is not investment advice. Please do your own due diligence. So this is an 8 billion market cap company at today's price point. They've bought back shares in the last couple of years. They are not paying a dividend, but I would not be surprised if they do in the coming years because they are a free cash flow machine right now. So as we look at the revenue growth, again, I'm not assuming they have to grow a lot from today's price point. 4% growth in the next year as guided, 3% growth after that, 2% growth in the out years, margins starting at 17%, potentially going to hit higher this year. They've been at 20% plus before when they're not investing a lot of money, but they're investing a bit in their brand right now. CapEx on this business, not very high, which is why they generate such nice margins, such high free cash flow. And then as I look at the out years, I kind of get to an endpoint of 18%. So not incredibly aggressive assumptions here. You know, the risk from the market's perspective is that this is a fad. This is a company that's not going to stick around. They grew so much in 21 and 22, but now they're going to start shrinking. They're going to come back down to earth. And if they start shrinking rather, this thesis kind of goes out the window. But I don't think that's going to be the case. I think Crocs is a healthy brand. It's growing internationally, has a lot of room for expansion there. The risk is always with Hey Brand. Will they keep shrinking or can they stabilize that? If they can stabilize it and start growing it again, then that acquisition looks a lot less bad from a forward-looking perspective. But right now, it's not looking very good. They took on all that debt and it's not really paying off. They would have been better off not acquiring that company at all, using the free cash flow from just the Crocs brand to buy back shares, not have all that debt on the books. Obviously, their thought process is, we can be more diversified with more brands, but it's not really working out right now. So they're going to generate free cash flow. They're going to use about a third of that, in my mind, to buy back shares, the rest to pay down debt. I think they can pay a dividend in the coming years. I wouldn't be surprised if by 26 or so, Crocs is a dividend-paying stock and in some dividend ETFs. That's just what a mature business does. And I think they're kind of reaching the point of maturity. The other perspective thing they can do is they can look at other acquisitions, essentially. This company that is going to pay down a good portion of their debt by 25, by 26, going to buy back more shares. And they'll have a balance sheet that they can use to do a lot of things, whether it's pay a dividend, buy back more shares, or make an acquisition. Won't speculate on that, but the assumption here is that they're not making acquisitions, just growing as they are, increasing margins a bit. From a valuation perspective, you're getting a 9 to 10% yield, depending on whether you're looking forward or back from a cash flow perspective. I think the right number is somewhere in the 7 to 8% for a company like this. That's just what feels about right and where they have reached during their peak. I think something like this is undervalued by the market simply for the fact that it's a one brand horse and it's not as good a brand as Nike. It hasn't been around as long and people don't trust it just yet. But if you can make that assumption, if you can make that leap and say that, 5 years from now, 10 years from now, Crocs is still going to be here and is still going to be in the mind of consumers as a good brand, a brand that does unique things, this could be a really good compounder because even if you put a 7 to 8% free cash flow yield on a future basis, you're getting about a 9% return from today's prices. And that's not super attractive, but it is pretty interesting. And if they can return to growth on Hey Dude, maybe the margin, the yield expands a little bit and you get a 6% yield, you're starting to look at low teens returns. From my perspective, I think that's probably a bit optimistic. And while I'm not selling here because I think the fair value is somewhere in the range that it's trading at right now, somewhere in the mid 120s, I probably wouldn't be a buyer either. However, if this keeps dipping a bit, if suddenly it's at a target return of 12.5%, which is about $110, or even 15%, which is $99, I'd certainly be interested in acquiring more shares of Crocs to build out my position. So I do own a small position in Crocs, sold a fourth of it not too long ago, but would be very happy to buy back more than what I sold if this thing gets into that low 100 range again, and because it gets very interesting there. You're talking about 10% forward yields again, and I'll take that any day, because that gives a business a lot of flexibility to buy back shares, pay down debt, eventually issue a dividend, make an acquisition, and I can wait for the market to fully appreciate this business for what it is. And again, if I'm wrong, then it's not a huge investment for me, but I don't think that it's a huge leap to say that Crocs is going to be around. And if you believe that, then the valuation here is interesting. And if you don't, then just stay away, because clearly the brand isn't for you. I think as an investor in Crocs, you probably have to believe in the brand and believe in the cachet it has and its ability to sort of keep selling these weird shoes and these weird gibbets, because that's kind of their business model. And in a recession, will a business model like that take a hit? For sure. And the stock price could come down quite a bit. But I think they do have the advantage against some of these other footwear companies in that a lot of their stuff isn't as expensive as some of the other footwear companies. It's obviously a different type of shoe, but if you can get a Crocs shoe for $29.99 or $39.99, that's pretty affordable even when consumers are struggling. And that's kind of showing up in the results when you compare it to the results of some of these other companies. It's not showing up in the guidance, which is the worrying thing, which is why I'm not ready to just call this a huge win just yet, despite the valuation. But if the Q3 earnings, again, show a beat over their guidance, you'll kind of get an idea of what their conservatism looks like and where they're actually headed. Because if they start showing that they can achieve, mid-single digits revenue growth for 2024, then this gets pretty interesting. And I think the market's already starting to see that a little bit. This is the stock that traded in the 80s. It's now trading in the 130s. So obviously it's a lot less attractive now than it was back then. But I think the market's starting to realize a little bit that Crocs is a pretty interesting business, and they have a lot of flexibility ahead of them if they can maintain even low single-digit growth for the next couple of years. So those are my thoughts on Crocs. Let me know what you think. Leave a comment down below. Like, subscribe. If you want to play around with the spreadsheet, file, make a copy. There's a link in the description down below. Thanks for watching. Have a good day. Bye. And if you hate this video, leave a thumbs up and don't subscribe and all that stuff. So, it is what it is. Bye.